Good morning. Welcome to this webinar on capital gains tax and inheritance tax, bearing in mind that the autumn budget statement will be announced on the 30th of October. My name is Diane Lewis. I am part of the Bevan Buckland tax team, and I'm based in our Cowbridge office. I've been working in tax since 1984, focusing mainly on tax compliance with private clients, sole traders and partnerships. And just some fun facts about 1984. Margaret Thatcher was in power. Nigel Lawson was the Chancellor. The highest rate of income tax was 60%, and actually there was a bit more, 15% investment income surcharge, but we don't talk about that. Capital gains tax was 30%. Capital transfer tax, which was the precursor to the Inheritance Tax Act that actually came into play in 1984, the rate was 60%. And with me today is Matthew Denney, tax partner at Bevan Buckland. So would you like to introduce yourself?
Thank you, Di. Matthew Denney, tax partner in Bevan Buckland, based in Swansea. My history goes back to about 1998, which will be quite useful when we come to talk about some of the topics today. I'm a tax partner at Bevan Buckland, and I'm based in the Swansea office, having effectively done tax all my working life.
Right, okay.
Should we dive in?
Yes, let's dive in. So, as I've already said, with Rachel Reeves' autumn statement due on Wednesday, the 30th of October, and given all the speculation about tax rises that people are talking about, we just thought now would be a good time to try and bring some clarity and a professional perspective on to everything.
Yeah.
So, with that in mind, Matt, as I've already said, there's a lot of speculation about tax rises, but can we start with what we know? What we think we know,
Okay, so we've had some commitments from Rachel Reeves that there'll be no increases to VAT, income tax and national insurance, which are the big three. The big three.
Yeah, that's absolutely right. Now, that's an awful lot of taxes that are being ignored. So we've got income tax, VAT, and national insurance contributions. Now, they account for about 63% of the annual tax take. So if we're discounting those, what options do we have?
So 63%, about 630 billion of our 1 trillion revenues. The next sort of biggest one is capital gains tax. So that's the one on everyone's mind. It's sort of, there's stamp duty, but the next big one is capital gains tax, and that's about 16 to 18 billion a year. And inheritance tax is less than half of that, even though it's been going up, and it's really gone up quickly.
Yeah,
it's a small number compared to the big three.
Okay, so currently, I'd say we have quite a benign capital gains tax main rate. It's 20% for assets and shares, assets and shares, and then it's 24% for residential property. So, if, as is rumoured, they align capital gains tax with income tax rates, would that effectively double the capital gains tax receipts?
Probably not. It's like we know this from history, that the best thing you can do is tell people you're going to raise capital gains tax, they go and sell stuff, that brings in lots of receipts, and then when they actually do go up, things tend to drop off. So it's like the law of diminishing returns. So there's this question about aligning capital gains tax to income tax rates is on everyone's mind.
Yeah.
We've never had that. And to really sort of understand this question, you've sort of got to go back in history. So just after you started, okay? So to really, you've got to go back to 1988.
Yeah.
And that was the last time that essentially the capital gains tax rate was the same as income tax. It was 40%. However, Nigel Lawson did probably the most sensible thing you could have done, and that was brought in indexation allowance. So whilst the rate was the same, everything was rebased at March 82. So you just sort of had to go to the faff of a valuation, but you got the valuation of your asset at March 1982, and then you indexed it. Because the reality is, if I bought a house in around about 1982 and sold it now, so I paid £100,000, it might be worth about £260,000 now with indexation allowance.
Yeah.
I've not really made any money because I can only go and buy the same house.
Yeah.
So I mention this because we've never had a situation where they're aligned. But what happened is indexation allowance went. This is where it got interesting. So in 1998, our old friend Gordon Brown, he brought in taper relief. And taper relief was the birth of we think of the 10% tax rate for entrepreneurs. It was what's called business asset taper relief back then. But he also had non-business asset taper relief. And this was something that lots of countries around the world do. So you say, well, look, if you make a gain in year one, you'll pay 40%, and then that rate will taper down. Yeah. And it tapered down over 10 years to get you 24%. What he left, though, was he left the indexation allowance. It was a bit of a faff. You had this situation where you had to index up until about, I think it was April 98, and then non-business asset taper relief. But the really business-friendly thing he did, and this was Labour, this isn't Conservative, he brought in the 10% rate for all trading companies, trading businesses, effectively. And that got more generous. So first of all, it was 20 for 4 years, then that became 2 years. But that was unlimited. Yeah. There was no upper limit. No. It didn't matter whether you made £500,000 or £500 million. It was if you qualified, it was 10%. And then it all went wrong. All went awry. Alistair Darling, in about 2007, I think it was, did the daftest thing. He scrapped indexation allowance, scrapped taper relief, non-business asset taper relief, scrapped business asset taper relief, and just said, well, let's just call it 18%. Yeah. Oh, but we've got entrepreneurs, so they may not have paid anything for their shares. Well, let's let them have £1 million at 10%. And it was this 18%, it didn't really make any sense. It was like, well, it didn't matter whether you owned it for a year or 10 years, it was 18%. It was like a one-size-fits-all. Yeah. But we all liked it, didn't we, right? It was 18%.
Yeah. Straight in and out.
Yeah.
It was just, and it was so unusual after fiddling with calculations for years on end. And then you get that announcement where it's just cost, whatever you get for it, profit. Whatever
nice
rate,
and easy,
and that's it.
Easy,
you're done.
Easy and benign. And then the million became for entrepreneurs relief, as it was then called. That became 10 million, and then it went back down to $1 million. And it was interestingly, it was not Labour that were mean. It was Osborne.
That was, I think,
Osborne brought the 10 million down to $1 million, and then he put the 18 to 28. Yeah. So this is the. And then it went a bit ski-whiff because then we had, we had 20% for non-residential property, and we had 28% for residential property, and then Jeremy Hunt knocked that to 24, probably hoping people would sell some houses, to finish hoylets and stuff. So that's a little history lesson, but what that tells me is we've never just had them aligned. There's always been something else. And so you always, it's a fool's game to guess, but I can't envisage a situation where there isn't something else. And the big issue is if they want to be business friendly, people that start companies do not have any cost.
No.
And so if you even if you give indexation allowance, there is not that incentive. So I think they will be looking very carefully at having maybe some higher rates, but maybe having something like taper or indexation or something that's something else that's business friendly, because it's not that simple, and it never has been.
And we've had the conference this week. Obviously, we've had the Labour conference, and it's been very quiet actually apart from we're business friendly. That seems to be a lot of thumping about that, but there's nothing else that's come out of the conference.
I've not heard anything.
No. So at the moment, it was all sort of social driven, about school meals for children and that kind of thing, but nothing really that's given us a steer on what's going to happen at the end of October.
Yeah.
So that's capital gains tax in a nutshell. We've got inheritance tax. Now, inheritance tax has always been at a 40% rate over a threshold amount.
Yeah.
So quite fixed. So is there anything that you think they might consider with inheritance tax?
So inheritance tax hasn't really changed in many years, other than the residence nil rate ban. So we had this concept of this nil rate ban, this £325,000 each, so 650 for a couple, civil partnership. And Osborne kind of brought in this, he wanted to get to £1 million, and he did that with the residence nil rate ban, and that eventually got you to £1 million. Albeit it was a bit more complicated, because if the estate was worth more than £2 million, you lost some of the residence nil rate ban. So they added this sort of complexity. But fundamentally, other than that, not much has really changed in many years. As I said, it collects about less than half the amount of capital gains tax, but the receipts have really been increasing dramatically. And a big part of that is because of fiscal drag, right? So the nil rate ban is meant to be going up, but then it never does. It never does go up. This is perhaps more difficult to speculate on, because we've had very few changes, and there's not something else you can look at and go, well, that would make sense. But having said that, the big fear is that they will get rid of the capital gains tax base cost uplift.
Yeah, so on death.
Yes.
Yeah.
On death. So if you inherit something, normally, well, under current rules, you inherit it at the value.
Yeah.
So if you sold it the next day, there wouldn't be any capital gains tax, which is fair, right? Because if you paid 40% inheritance tax, to pay whatever the rate is, 28, 24, 18, whatever the rate might be, it's like a double whammy.
Yeah.
And so that's where the speculation is. I think that's a bit harsh, but you could see a situation where they remove the base cost uplift, but don't tax it at the same time.
Yeah.
So if my parents had left me a house they'd paid £100,000 for, and when they pass away I inherit it and it's worth £400,000, and I've got to pay the inheritance tax on that £400,000 at 40%, and then a few years later I sell it for £500,000, my capital gain is based on the 100 to 500. I think that's what we're kind of fearing as being, because if they're going to change the CGT rate, and that goes up, it's like, well, if we do this as well, and people have to sell stuff potentially to pay the inheritance tax. So that's kind of where fear there. Around the edges, they talk about tightening up the reliefs, because they can be a bit potentially over generous. So business property relief, agricultural property relief, but how they go about that, it's going to be tough.
Yeah, I mean, if they withdrew agricultural property relief, as an example, we wouldn't have any farmers. So, we need to be really sensible about how the economy operates. And, we're in a bit of a sticky situation, and we need the economy to grow. So there has to be a balance with whatever they decide to do.
And that's the hardest part for Rachel Reeves, is the balance.
Yeah. And obviously they've made promises within their manifesto. And so now, as you've already said, isn't it, civil servants will be scratching their heads trying to make all this right. And
absolutely. Absolutely.
So there's going to be a bit of a tussle between the Treasury, I think, and the government about what they can actually do. So we've got inheritance tax and capital gains tax. They're both quite complicated, and we've kind of addressed the issues around that.
Yeah.
So, we know that. So there's two issues there, but is there anything else the government can do in terms of taxes for a quick win now?
Well, they've done there's sort of three main ones. They've done the VAT on school fees.
Yeah.
We know about that is coming in. I don't think it will necessarily collect as much as they think it will, because those schools will be able to recover their input VAT, but that's there. One of the more esoteric ones is private equity funds. They pay a strange rate of tax. They pay 28% capital gains tax, even though it's sort of an earned income.
Yeah.
But I think that's not a huge amount, but I think it probably puts them on a par with other countries.
Yeah.
And one of the bigger changes that we do hear about is the non-doms. And to be fair, it looks quite sensible. It's kind of bringing us more in line with what other countries do. So inheritance tax is not based on this odd domicile concept, which is like a very old common law concept. It's like, where's your domicile? Well, it's not defined very easily.
No.
It's going to be based on long-term residence, broadly 10 years. So they're not going to affect many people, and they're not necessarily going to bring in huge amounts of revenue, but they are, I would say, you can have a different view on school fees, but the other two, I would say, are broadly sensible things they're doing.
Yeah. And of course, the biggest elephant in the room is pensions. We've seen a lot of changes over pension rules in recent years, especially most recently, Jeremy Hunt. He abolished the lifetime allowance of £1 million. But at the same time, he increased the annual contribution limit from £40,000 to £60,000. Now, Rachel Reeves and Keir Starmer, when this happened, they turned around and said, oh, this is a tax cut for the rich. We're not very happy about it. We're going to reverse it. Now, since they've come into power, they've changed their minds. And there's a lot of issues around that. So is there anything they will do with pensions?
The pensions is always speculation. There's always speculation. And I think what frustrates me about pensions and politicians is two things. One is there's a bit of sort of dishonesty, I think, if we're honest. And the other is that it's unfair that you go into a pension with an expectation of certain things and then they get changed. But they know that, and that causes them significant problems in legislation that isn't effectively retrospective. So, for example, you go into a pension thinking, well, I can take a 25% tax-free lump sum.
Yeah. Well,
if they change that, it's like, well, hang on a second, those were not the rules that we knew when we went into this arrangement. The dishonesty part that I think people should be aware of is this kind of, it's a tax cut for the rich, why would the Conservative Party do that? A big part of why they did that was doctors. And the way the annual allowance worked, the £40,000, doctors were effectively getting a tax charge on money they don't have yet.
Yeah, that's because of the type of pension scheme they're in.
Exactly.
Yeah.
So it's hard for a doctor. So hang on, I've had a promotion, I'm working 5 days a week, and you've given me a tax bill, but I'm not going to see that money until I retire?
Yeah.
That's not, and then they were also impacted by the annual allowance. So they could have these two sort of dry tax charges in respect of funds they may not see for, 20 years possibly.
Yeah.
So when Jeremy Hunt did what he did, it was, in large part, I think it must have been because of that. But Keir Starmer knows that most people won't get it. He can't say, we're doing it, it makes sense for this reason. Yeah. He just has to say, it's a tax cut for the rich.
Yeah.
And he's got his own
unregistered pension. Which is another thing.
Which we shan't go into because we are non-political, but it's a point of fact.
Yeah.
It's a point of fact. So I think it's difficult for them to do these things because there are the unintended consequences.
Yeah.
So if you think about, we can't. There's a reason for not messing around with the lifetime allowance. There's a reason for not messing around with the annual allowance. Yeah. That kind of leaves two scary things, I suppose. Reducing the tax-free lump sum, which is always speculated about, and I'm not sure that it can happen because you've made this sort of promise. And in actual fact, the tax-free lump sum is not 25% of everything. It's limit. They kept the lifetime allowance roughly.
Yeah.
So I think it's something like £276,000. It's sort of capped. They've sort of done a little bit of that maybe already, which is not really retrospective. That seems okay. The scary one is reducing the income tax relief we get on our contributions in. Yeah. Something in between, It's like, if you're a 45% taxpayer or a 40% taxpayer, do you only get 30% relief? Yeah. Enough that there's money going in for Rachel to have the pension funds to invest in the UK, but not so much, it's not so stingy that people turn those pension contributions off.
Yeah, interestingly enough as well, they're talking about bringing the level up to 30% for everyone. So whereas your basic rate taxpayer gets 20% at the moment, we all get the minimum 20% tax relief. They're talking about a flat rate of 30% for everyone. Now, how they manage to do that, in payroll schemes, I really don't know how they're going to work that out.
They'd have to send it direct.
Yeah.
They'd send it direct to the pension fund.
So, it's there's a lot of tinkering going on with pensions, and it will be interesting to see what they actually do with it in the end. It's very difficult. It's a minefield because you're talking about people's future savings as well.
Yeah.
And
people just want to know, right? And if you keep changing the rules, keep moving the goalposts, there comes a point where people think, well, do you know what? I might just go and buy an investment property.
Yeah,
it's exactly the thing they don't want to happen.
No, absolutely not. So now we've covered, a lot of the issues again. What actually will any of this actually be specific to Wales?
The only sort of taxes of note that have been devolved are in Wales is land transaction tax. So if they announce some sort of first-time buyers relief, that won't help, and I don't think Wales have not followed suit. They've gone down a slightly different path with land transaction tax. It's generally more punitive in Wales, generally more costly. Wales can change income tax rates. It's got within the bands, but it never has. It's never sort of made any indications that it will. So, I think the short answer is there's probably nothing.
Yeah, it's interesting, isn't it?
Specific to Wales.
Devolved tax rates. A choice of devolved tax rates like Scotland. So Scotland's basic rate at the moment is 19%. Their highest rate is 47%. There's a lot of fiddly little bands in between. So you're knocking 1% off the bottom and adding 2% at the top. So I don't really...
It just feels political. It's political tinkering. It's of no real practical effect, I don't think.
Exactly. And what are people doing at the moment in advance of the 30th of October?
Well, people are selling things. I mean, there's no doubt that people are accelerating the sales of things that they were going to sell or gifts they were going to make. It's difficult to advise on, but it's definitely happening. And part of that is because if you tell people this, let people think tax rates are going to go up. It's great. They go and sell stuff. 24% or 20% of a lot can be more than 40 or 45% of not very much. And that's what history's told us. So, it is happening. It is happening, for sure.
Yeah. And what should people be doing? Now, that's an interesting question. It's a very difficult time to be advising clients in this situation, isn't it?
Yeah. So, well, first of all, they got to take advice because circumstances are individual and we don't know what's going to happen. But I suppose if somebody had made up their mind about doing something and were going to do it, if a property has been on the market and you've got an offer on that property, maybe you can get that sale through. Well, people are obviously going to think about, well, if I can get things done that I was going to do, then you've got to think about doing it. The more difficult is where there's gifts, because you still pay capital gains tax on gifts.
Yes.
So people will be thinking, well, I don't need this particular asset, so I was going to give it away. Do I just get on with it because it could save me if the CGT rates go up? Yeah. It could be more expensive. It could be cheaper.
Yeah, this is it. We just don't know.
It seems unlikely.
Yeah.
But unfortunately, there's no easy answers.
No. Other than $6 million question that's going around at the moment is: will everything come into effect on the 1st of November? These changes. Or will they defer everything to the start of the new tax year so that it gives people an opportunity between November and the end of March, beginning of April, to carry out transactions if they want to or plan ahead, knowing that these new rates will be kicking in April? So
in the past, there's been a mixture of immediate...
Yeah.
So for example, they changed the rules on furnished holiday lets.
Yep.
to take them out of the more relaxed rules. So the income tax, full tax relief on your mortgage interest, roll over or hold over.
Yeah, you get business asset disposal relief.
And BADR. So they're all going, but then they're not going until the 6th of April next year.
That's right.
And so, for example, it should be possible, under the current rules, depending on all the qualifications, but to give those assets away, if that's sensible, and hold over the gains. So quite often things, and sometimes the reason they delay it is because, of course, they want people to trigger some tax.
Yeah.
Again, 20% of a lot is better than
that's it,
45% not very much.
Yeah.
So some of the things are quite strategic. With the actual capital gains tax rates, in the past they have gone up from the morning of the budget. So you can't rush off to the solicitor that day.
No.
It's too late.
Yeah.
Because it's too obvious, isn't it?
Yeah, that's right. Yeah, shut the door. Yeah.
And that's when it went from 18 to 28. I forget the year. I think it was 2018 or 2008.
Yeah.
Went from, but that was July, and it was like that.
Yeah.
This one's a hard one to call. This one, because by making everyone think the rates are going to go up, people have sold the stuff. So maybe they don't actually need to put them up.
Yeah.
On the date.
Yeah.
They're better off going, we've had quite a lot of money in.
Yeah, we'll bank it. And
we'll tell people it's going to go up to whatever it is by the 6th of April, so they go and sell more stuff.
Yeah. Yeah.
And that'll bring some more in.
Yeah. So that effectively covers off everything that we wanted to talk about. I mean, we could talk, about the pension.
We've had one question come in, which is actually a really, really interesting question. Not one I can answer. It's a good question, but not one I can answer. But it's it's from Martin. I shan't use the full name. So Martin has asked, these changes aren't going to be enough to fill the £22 billion black hole. No. So how will the books be squared?
Yeah.
I mean, the short answer is I don't think they will. No, I absolutely don't think they will. But we talked about how accelerating stuff or telling people things are going to happen has had an impact. But if you're going to leave the big three alone, you're struggling. You're struggling. So it's got to be growth, I suppose. I've had another good question here, which is quite morbid, actually, but we've got a couple of minutes left. I've always been advised by clients that the best way to avoid CGT was to die. Is it?
What is it, that quote, isn't it? The certain things in life are death and taxes.
Death and taxes.
Yeah.
Is it possible there could be a double charge to CGT and IHT on death? Yeah, that is the big worry. There's been a lot of speculation that it's particularly where you've got assets that don't attract inheritance tax for whatever reason. So, if you've got a situation where you've got £1 million in bands, you inherit something. Yeah. And then you can sell it the next day with no tax. That's quite generous. Yeah. And there's business relief and agricultural property relief. So, if I had to guess, I would say that I can't see it being immediate. I can see that you carry that base cost, the old base cost, forward. Yeah. So when you calculate your capital gains tax, maybe at an increased rate. Yes. That it hits you when you actually sell it, not actually on death. Yeah. Yeah. Right, I think we are exactly on half an hour. Right, so... And... Yeah, I hope that was beneficial. And we will be doing a follow-up webinar after the 30th of October statement, and when we actually know what Rachel Reeves has in mind. So keep an eye out. We'll be doing a follow-up webinar. We'll find out how close or far away... Yeah, we are. We are. Okay, thank you very much.